Hello and good afternoon, everybody. Um, Thanks for joining today's session. I'm still going to wait a couple of minutes for people to join in last minute. And in the meantime, we'll already start sharing my screen for the presentation and kick things off in 3 minutes from now. So while the final attendees have a couple more minutes to join, I'll already start off with some household announcements for this session. I expect we'll need about 90 minutes, and you have the ability to interact and send questions via the Q&A. So I believe by now my screen should be visible because it's being shared. If it's not visible, just post a question or let me know about it. But as far as I can see from my end, it should be working. And before we will start in a minute, I'd like to thank everybody already who has joined on time, and looking forward to host this webinar for you and help you understand what it means to build, launch, and operate your own token, and help you to avoid any common mistakes in that journey. Right, so it's 2 minutes past 1. Again, thanks everybody for joining. I hope you can all see my screen. You can send me any questions during the presentations via Q&A. And what I will do is that every couple of minutes, I will check in on the questions that have been sent and will answer them in one direction. So I myself just got back from Token2049. We decided to move this session actually post-token so that people have the headspace and the time to actually attend this online event. And I'm glad to see there has been such a demand for what we have to share, because for me, it's a clear indication that founders and also VCs really try to understand what it means to build, launch, and operate a token and avoid any mistakes during those different phases. And it's my goal in this session to help you move from unclarity and uncertainty to give you a better understanding and also show you how you can be more data-driven to get more confident about your decision making. So yeah, we'll have about 90 minutes, and I will share the agenda for this session in a couple of minutes. First of all, for those who don't know me, my name is Vincent de Vos. I'm based in Netherlands. And I'm the founder and tokenomics architect at Chainforce. I come from a computer science background, got into crypto probably like most people around 2015. And ever since have been exploring the crypto space, distributed ledger technology, and been involved in different use cases of blockchain, Web3, DeFi, being a contributor to several DAOs and on-chain protocols. And took me a couple of years before I actually started to work as a freelancer and an advisor in the space itself. Because before that time, I was working in software engineering and software engineering management. It was around 2018 for me that I started to really, 16 I mean, when Ethereum opened up their blockchain, making it a decentralized computer, before I really could grasp and understand what that meant. And once I had a full understanding of this notion of decentralized administration of value, and for businesses to kind of innovate with tokenization models, I really started to pivot and move myself into the blockchain space, and I haven't left ever since. Because for me, the idea about running a business, innovating your business model through tokenization and through tokens, I think that's an incredible opportunity. Which also makes me founding Chainforce in 2021 to guide and help founders doing that. So if you want to connect with me, you can scan the QR code. There will also be a code at the end of the presentation, or you can connect me on LinkedIn. Happy to connect with any one of you after the presentation. So for today, I'm going to tell you a bit more about Chainforce, why we run this webinar or this event, share some personal thoughts after being in the space since 2016, make you aware as a founder and also a VC of the responsibilities that you typically have during those different phases of designing, launching and operating your token economies, and also help you understand and give you a different perspective on what it means to run a token economy. And then I think most time will be spent on actually highlighting and talking through common mistakes that I see and recommendations that I like to give you while you're navigating this phase of your business. And we will have some room for Q&A. So as I mentioned, it's kind of one directional, like I cannot hear you right now, but you can actually send any questions you have using the Q&A functionality. So I'll start with the introduction to Chainforce. So I'm the founder. We're based in the Netherlands. We've been operational for 4 years now. We work with a team of experts in data science, computer engineering, and econometrics and financial planning and analysis, which gives us a really good combined skill set to handle different challenges when it comes to tokenization models, designing, and quantifying. We worked with over 100 clients in that period and helped our clients to establish decent market caps and give them the opportunity to build their business on chain. And something we're very proud of, obviously, because we believe blockchain values are here to stay, and we want to see more of that. So primarily, we focus on concepts, businesses, startups within the crypto space. So DeFi, Web3, decentralized AI, decentralized science, deep in GameFi, anything with tokenization and a token model. And we help you to build, launch, and operate with confidence through our data-driven methods. And what this in practice or generically could look like is that we help you move from ideation, strategize about your token design and token sale and launch strategy, all the way up to creating tokenomics models, auditing them, optimizing them, developing the token, creating dashboards that you can monitor on chain, helping you really bring the token on chain and into operations. So this whole journey is something we understand very well after 4 years, and that's why we offer consultancy and advisory specifically on this kind of roadmap. Now, having worked in the space for 6 years and wanting to share my thoughts and opinion and highlight any mistakes, I do have a couple of personal thoughts that I like to share. And because the space has been moving through different phases of so-called bear markets and bull markets, different narratives spinning up and down, I think the fundamentals have remained the same. And the blockchain values of transparency, efficiency, and new ways of ownership, those remain intact. And the innovation, which is decentralized networks that you can use for value administration, I think it's still one of the biggest innovation, next to AI likely, that we're seeing in our time. And this means the opportunity is still there, and it's getting bigger because the whole infrastructure is already built. So it means you can use tokens and tokenization to unlock business model innovation and drive economic innovation with like new ways of value transfer, sharing of future cash flows, allowing on-chain governance, providing new ways of access and new ways of representing assets on the blockchain. And doing that, you can actually attract and activate and retain users, clients, and any other stakeholders to amplify the growth of your business, and therefore also its capability to actually create value and generate revenue. Now, with these fundamentals and opportunities in place, I see a lot of recurring challenges and mistakes being made. And this happens because not everybody understands what it means to design and launch and operate a token responsibly and what these responsibilities entail. And that I see token models not being designed to fit the objectives and the constraints of the business, which is what design is all about, kind of fitting the purpose. There are designs that are being reused, copy-pasted, without proper validation, where you kind of risk it all because you're using a different model to fit on your business, which is like running a SaaS business, but deciding to use an e-commerce model on the finance side. That doesn't make a lot of sense. I also see tokens being launched. We're all talking about TGE today, but they're not being valued. There's no valuation. There's no understanding about how value accrues in the token and what would make a fair token price. So without that understanding, you're never able as a business owner and even as an investor to make sure you're sustainable long term. You're kind of gambling and guessing that it will work out long term. And in the end, it's about also operating the token model and like not operating it with the right technology, not operating it with the right key metrics and finances in place. So that's what I'm going to address in this presentation or in this event today. And I like to encourage you to understand your responsibility and take it. If you don't understand it, educate yourself, surround yourself with experts and professionals, and don't think short term, like build things for the long term, because that's what this space really needs. So let's start with the responsibilities you have during the different phases of building, launching, and operating a tokenized business. And I think it all starts with having a solid foundation for your design, which I think means as much as having a clear business objective, where you want to end up, what you want to achieve, and understanding very clearly the utility and the purpose of the token within that business model, and that you align it with investors and contributors and your team, and that you craft a sustainable and a data-driven tokenomics model that is actually backed by data and stress testing, and not just one that has been copy-pasted. I think it also means making sure that when you issue the token or when you tokenize a part of your business, that it complies with regulations where you're operating, and that you have a solid entity and legal foundation in place to operate from. And that the model you bring to market actually has the potential for value creation, and that can redistribute value as well from day one and not as a promise after 3 years. So I think design is a really important responsibility and aspect that's crucial before you decide to go to market. The second pillar, going to market with a data-driven strategy, I think it's all about developing a fair and effective token launch. Doesn't even need to be a sale, but at least understand what it means to economically operate your token and at what price. And that you fit a token model with its distributions, liquidity provision, and vesting schedules to fit the projections of your business instead of only your fundraising requirements. And that for this, you also use post-launch simulation scenarios so that you can actually identify it and mitigate risks early on, so that you can optimize the model long-term instead of having to redo everything once you're already into the market. When you go to market, it also means you have to operate on chain. So it means you need to put your guarantees of token vestings and allocations and of the promises you basically make to all your stakeholders in the ecosystem. It needs to be enforced on chain, which is something I'm going to highlight later in this presentation on what problems it gives if you don't, and also how you could mitigate it and what solutions there are to help you do that without having to build everything yourself. And now that you have the token in the market, or it's on chain, it's connecting your ecosystem. Now I think it's just starting. So now it's about how can you now grow the token economy sustainably long term, which is, I think, not just hype and doing marketing and KOLs. I think it's more than that. I think it's about really using the token how it's supposed to be used to incentivize, to attract, and to retain users, and to monitor your operations on chain, like using on chain data to make informed decisions so that you can respond to market feedback, so that you can optimize using analytics. And making sure that at every stage after you have launched the token, you use that on-chain data to validate and maintain the alignment between how the token is used and how you've actually deployed it and are currently distributing it. And I think by doing that, you're going to ensure that you have more ongoing value creation, value capture, and then also value redistribution, which makes it full circle. Okay, I don't see any questions so far, so I'm going to continue with my next slide. So first of all, let's address the term of so-called tokenomics. It's a deliberately broad term that I still use, even though it's much more nuanced and it's a very practical and lazy general gist that's just clear to most people. But if we zoom in, if we look at, I want to build and operate a token, and I need to make sure that tokenomics are like, I need to do tokenomics work. I need to make sure it works well for my project. There's different elements under the name of tokenomics that you can look at. So consider it a generalization. It's a kind of collective term, but it means a couple of different things when people use it. So when you talk about tokenomics, I always ask the question, are you talking about the utility design, about what's the role and the purpose of the token and how does it relate to your business? Or are you talking about how it's incentive design on like how you can use the token for the innovation that it is to attract, retain, and activate participants in your ecosystem? Or are you talking about its ability to also raise funds and its token launch strategy? So there's already a couple of different topics within tokenomics that you can evaluate and discuss. And where most people think about the typical charts of allocations and vestings, tokenomics is much more than just supply design, which is what most people refer to when talking about tokenomics. It's how many is the supply and what's going to be my ticker and how am I going to allocate across these different stakeholders. That's obviously an important part of tokenomics on the supply side, but you also have a demand design for your token, and that should be actually aligned with any projections and any ambitions you have on your token model. Because if you only talk about supply and you're not balancing it with the demand and how you can design to increase demand, it's likely not going to be a sustainable model. And it's really important that you consider both as a side of the same equation and that you keep them balanced. And I think the last one is also considered to be a part of token economics. It's the governance design. What kind of policies do you put in place for token holders to have interaction with your ecosystem and put out a vote? And do you vote with a 1-1 ratio, or do you put quadratic voting in place to make sure there's a diminishing return on the amount of tokens that you hold? So that's also a crucial aspect of tokenomics, in my opinion. And I'm going to continue to use this term for now, and I will double click on the specifics when it needs to get more nuanced than that. So I'm going to jump into the more practical and specific concepts now that I see happening with founding teams, core teams, founders that are in the phases of designing and launching a token. And I distill them into 5, I would say, crucial mistakes. The first one being quite fundamental, it's about having a weak or just an improper token design for the business model. So like people talk about token design all the time, and it's really important because it kind of sets the stage for how value is going to be captured, how value is going to be distributed, and how your token is going to support your ecosystem or your business model to achieve all its objectives short term and long term. I also going to talk about disregarding fair launch principles, which I believe in the decentralized space is I think it's a bad idea to ignore fair launch principles completely, because you're attracting different stakeholders into your ecosystem. I will double click on this in a couple slides. Also ignoring fair token value, like the right pricing of your token, determining at what rate your token will need to be like bought back at some point or added to liquidity. I see a lot of unrealistic benchmarks, and that is leading, in my opinion, to token price charts that can only go down, and because the business never has been able to generate enough revenue or enough value to create a upward price motion, because it just has been priced wrongly from the start. Then I see very important questions that you want to answer before you go to market, not being answered because simply there's no effort being put into validating and stress testing of a model. So I see a lot of people having a token model. You copy paste it, or you work with an advisor that has good ideas on design. But a model is at that moment still a model and a design, and it doesn't mean it's the right design for your business. And there are ways right now that you can actually validate it. So you can stress test it on the different scenarios, you can implement it into simulations, and by not doing that, you're jeopardizing the long-term horizon of your business. Maybe not so much for your investor, because they typically try to get out of your ecosystem earlier. But you as a business owner, as the entrepreneur, you're stuck with this model for the long term. So it's important you consider stress testing it. And the final point will be poor token distribution, and also poor token management practices, leading to supply shocks, which will typically lose the trust, not providing that transparency because token management is all being done from one wallet without using the proper smart contracts and software for it. Monthly payments are being done manually, leading to potential problems or potential mistakes. So I'm going to zoom in on every mistake here, and at the end of every slide, I will also pause and have a look at the Q&A to see if there's any specific questions about it. And I already see a couple of questions here about, yes, the recordings will be shared. How we price a token fairly, I will zoom in on that. What work it takes to get to a fair token price estimation. What's your perspective to the memes project? Well, to be very short on this, we don't work with meme projects because we cannot add value to the business model, which is marketing. So I think memes can be great brands if they work out, but they're too speculative and too marketing oriented, and typically don't have any inherent value unless used as a loyalty token to the meme brand. I see another question coming in. What are some best practices for fair token launches? How are they successful overall? Yeah, so I've dedicated slides for these common mistakes. So I'm going to double click right now on every one of them. Thanks for asking. One thing I want to highlight, there's a lot of nuance going into token design, token models. So it's always a bit of challenge for me to also try to capture the general mistakes and general solutions to it. Obviously, things are typically more nuanced, but I'm still trying to give you a taste and an understanding of the typical solution directions and what you should be looking for. So starting with weak token design fundamentals. So if your token has insufficient utility or weak value capture mechanics, which in my opinion means there's not a really strong relation between your business model and your token, and you cannot capture or redistribute value, it's going to result in a couple things. It's going to result in a lack of sustained demand for your token because there's no long-term value and it doesn't have a good use case for utility, which in return is going to lead to weaker network effects, which is not necessarily a problem for all concepts, but definitely in DeFi and building a platform which is multi-sided, you actually want to have those network effects to get your business model off the ground. And this is in return going to lead to speculation, which is going to create volatility in your token up and down instead of gradually having a token that's just going to grow upwards in the long term. And my opinion, the solution to it is looking at multiple layered uses of the token to create diverse demand drivers, making sure that you get stronger network effects, and by that also having longer sustainable value. If I would give you 4 steps to do your own token design, I would say you first start by defining the objectives of your business and identify the core functions of your protocol and ecosystem. You're going to try to answer the question how the token is going to help achieve that. And token can be used. There's all these different kinds of utilities, but what utilities are inherently a good fit for your ecosystem? And then implement those. And then the next step is also about thinking how you're going to capture actual value in the token long term. So if your business works, how is the value from the business going to be reflected in the token value capture so that you can redistribute that value across all token holders? And when you're doing that, I think you have a perfect position to also expand and explore opportunities across protocols, look for other ecosystem expansion opportunities. And that means if you look at I would say, hands-on approach to this, urge you to ask the question, how can you add so-called multi-layer utility to your project? And when I talk with clients about this, the focus tends to be on one kind of integration, about one way that it can be used. So it can be solution access, and that makes it a good token to have utility. And that's not always the case. You can look at adding utility across different stacks, across different layers. So for example, you can use your token to grant access to features, discounts, or premium services, just like the way Uniswap V3 is doing this. You can also use the token for value capture that will give the token holders a long-term share of revenue or profits. So long-term incentive and with economic benefits. And you can offer these both in your token. You don't have to only have one. You can layer them and add them on top of each other to make it a more compelling proposition as a total picture. And then there's obviously what we've seen a lot, I think, also during the NFT boom, is that you had all these communities integrating tokens into their protocols and broader ecosystems. You also see it a lot in DeFi, where the Aves GHO stablecoin is used as collateral, and token is backed by other assets. So I think it's a great way to layer your utility and make it a more compelling proposition to future token holders. And by making sure it's not just a medium of exchange, but it's actually a really integral part of your business. That's what's gonna create the demand and make sure that people stay connected to your ecosystem and not sell a token at the first moment they can. Which is the downside of having a DeFi infrastructure, right? There's liquidity everywhere, and you need to have a compelling proposition for people to continue to remain in your ecosystem. Before I skip ahead, I'm going to look at the Q&A again. Okay, that's a good question here. I'm going to address it. And another question I'm going to skip because I'm going to address it in a later slide. Could you please expand a bit on value capture mechanisms? Good practice versus bad practice. I think a practice that I see a lot, which I think works by design, is by making sure that any value creation that happens in the business model, whether it's revenue generation, could also be people providing data to the network, that value that's captured is going to be shared through that token. And by putting it into liquidity, by buying back the token, by adding additional liquidity. Because what you do as a business in that way is you kind of open up your balance sheet and your treasury, and you give everybody with the right ticket, with the right token, access to a portion of your business's value, of your business treasury, which is an incredible innovation, because it's really hard to do in traditional way, in the traditional finance, because you need to put in a lot of rules and contracts. And in DeFi, you can create a liquidity pool, or you can make sure your token is trading on an exchange. And all of a sudden, everybody that has a involvement in your ecosystem and holds a token as a token holder can now buy into or buy out of the ecosystem. So I think a great value capture mechanism is that you dedicate a portion of your profits and revenue back into liquidity, so that there's a long-term value share with everybody that incentivizes them to do more business with you, do your marketing, and have a long-term incentive to work together. Another question, whether it's a common recommended practice to share 100% of revenue to token holders. Well, so this is where also your business, the kind of business model that you operate, and the cost structure of the business. If it's an on-chain business, it might be different than that. You also have partial off-chain revenues, but in the end, you cannot dedicate 100% revenue to token holders. You can only dedicate profits by adding it to liquidity, and you want to share the profits that are a surplus that still allow you to kind of innovate and expand your business long term. And this is something you can actually simulate under different scenarios. What would happen if I would dedicate 100% of my profits versus 50% of my profits to token holders? What would that look like? That's a good question. Thanks for asking. So how does the value get captured and distributed? Does this not create risk with securities regulations? So first of all, we're no legal advisors. We typically work within the boundaries of legal memos that are typically tailored to the kind of business and also the entity structure of our clients. There's definitely a risk that if you just do redistribution of value in the traditional way, that you could be classified as a security. That's why it's important to do that in a very decentralized way, where there's no direct kind of one-to-one relationship. So using a liquidity pool to add liquidity, and like there's no fixed price. Those kind of mechanics are very common, but I will always recommend you to work with a legal expert on like getting the actual boundaries within which you need to operate to establish this. Right, so I'm going to continue with the next common mistake that I see happening. It's completely disregarding fair launch principles. And just like everything is not that black and white, it's not that you can only do fair launch and not do another kind of launch, but there's some principles in here that if you adopt them, if you show that you are using them, are going to be beneficial and attract, for most participants, the trust in your token or in your business. So it will foster trust. It will make sure it will help decentralization, and it's going to avoid some very common liquidity challenges as well that you see that happen if you do not stick to these fair launch principles. So I feel as a founder, you need to be at least aware of these and consider them in your go-to-market strategy. So what are these principles? So they're all about building trust and decentralization by eliminating big insider advantages. Does this mean you cannot have a private investor? Well, obviously not. Your project needs to be funded. What's different owning 5% of a token with 10 investors or having 35% of a token with a specific group of investors. So you want to be on the lower end to avoid so-called retail being used as exit liquidity for those specific investors. Also, giving big insider allocations are going to give a lot of sell pressure that you cannot control, and they will open up your ecosystem or your token for manipulation. So even though you can have vesting schedules in place, which I would encourage, not all investors will accept it. You still need the funds, and then you have to trust your investor. He will not dump his tokens whenever he has the opportunity. So by lowering that, I think you make sure you don't run that risk and you avoid these kind of initial liquidity challenges that come with that. By doing that, you do get a lot of good investors on board, and you're going to create also more confidence with anybody who is not a direct investor in the early phase, but in a later phase, and that come into the project because they're using the product or because they want to engage with your ecosystem. So I feel overall, thinking about this, realizing that these principles are there, it's going to help you consider what's the right strategy for your project. And the way you can adopt these principles, like what do you now have to do in practice to actually show that you're adopting these principles? I think it's first about being very transparent about your tokenomics. So this is transparency about your allocations, about your pricing, about your schedules of vesting and locking, having a really formal document, like a white paper, obviously, that highlights utility and value capture mechanics, and even building a dashboard that can be shared with your community to show what smart contracts are there, what interactions, who are the biggest wallet holders, who are the biggest token holders, what are their wallets. Really try to be as transparent as possible with these crucial parts of information. You should also consider optimizing your vestings and unlocks so that you don't get those liquidity challenges initially, and that you have long-term gradual vesting, and make sure there's no disproportionate unlocks, supply shocks, and inflation happening. So that it is fully aligned with the long term of your business projections. Fed token launch also means more equal access. I think it's never completely. It's a challenge to provide complete equal access, but you can still avoid very big insider allocations in a private sale if you do a private sale. And you can explore not just raising funds in private, but also look for IDO models where you actually launch the token on a decentralized exchange with a liquidity pool where everybody gets access to the liquidity immediately and also at the same kind of prices, which is something you can actually combine if you do it well. I'm going to see if there's some questions about it. What do you mean by sharing and redistributing value to token holders by adding liquidity? Not sure if I heard it right. Yeah, so the way that you can share in value, like economical value, right? I think there's two components. You always have, if you have a utility for the token by itself has value because it can be used for a specific functionality. But a big part of being connected with tokens to the DeFi ecosystem is that you can also redistribute value across those same token holders. So if you establish a liquidity pool that allows token holders to swap in or out your ecosystem, so you deposit USDC, you get your native token, or you swap your native token for USDC and like back into a more liquid asset. If you add liquidity as a project, you're basically putting some treasury from your balance sheet, which could be off-chain. It could be a bank account. It could be another wallet that's not connected to the token. But by adding liquidity to the liquidity pool or buying back your token, you're basically redistributing economical value with token holders because it allows them to swap that token back into a more liquid asset. So that's what I meant with sharing and redistribution of value. This might be a bit conceptual at first and very high level, so I'm gonna do my best in the next slides to also get into much more specifics that I think most of you will also be interested in. When you're designing your token and you want to go to market with it, you need to assess and understand its token price based on your business model. Because it sets the tone, it kind of sets the stage for how your business is going to interact with the token in the open market. So if we, for example, talk about buybacks, which is a very common value mechanic, the business generates revenue. Revenue is used to kind of buy back or add liquidity to the liquidity pool. And by doing this, there is more liquidity and the token price should be moving upwards. It's very different if you need to buy back tokens at a price of 1 cent or at $1, because there's two orders of magnitudes of difference, so 100x. So it means that if you need to buy back one token from your revenue to maintain a stable economy, and that token in the open market is established at $1, you simply need to generate more revenue to maintain that stable economy. So what's really important there is that you actually evaluate your token price based on your business projections. Because once you've set it, the token price will determine what the market cap is going to be, what the fully diluted valuation going to be, and you now have an economical requirement on like the future price of the token for buying it back. So you can shoot yourself in the foot with this very heavily, meaning you start with a price that you cannot maintain based on your projections or your business revenue. And now the only thing that can happen is that the token is going to decrease in value because you don't have sufficient economical value in place for your buybacks. And what happens is that investors have an opinion on price, and you have an opinion on price because you want to fundraise, and you let your price be dictated by that. And what I would recommend you to consider is turning it around. Like, first look at your business model and your capabilities to generate revenue. Understand how much economical value your business could generate, and then try to match that with the actual with your actual token model, so that it's something that can grow over time. And what this looks like, so let me just give you an idea here. So if you want to do a fair token valuation for your own business, I urge you to take these five steps. First, you define your tokenomics role in isolation. So you really need to map out how your business revenue is connected to the token, and how much of economical value will flow into the token at every stage of the business. And you're going to use some assumptions in that, but that's fine as long as it are conservative and pessimistic assumptions. You have a baseline that you can operate from. So now that you have a value flow in isolation, so something like 100% only connected to your business and not by KOLs, not by exchange volume, not by hype and market demand, just purely your business, you can now start mapping business economical activity to token demand. So you can actually create this relationship between 100,000 revenue generated in your business and how that translates to token demand if you do, for example, buybacks, or if you add specific kind of utilities in the business. And that means you now get a relationship, an economical relationship between those two aspects, and you can start to do some benchmarks. So you can look at real world metrics from other projects, look at their revenues, look at their fully diluted valuations, and set a benchmark within which you want to operate with your project. So not overvaluing it, being realistic about the kind of token demand that you can generate as a business, and use that as a sanity check and keep yourself accountable when establishing that price. And once you've done that, you can actually apply so-called scenario-based modeling. So what you can do is you take your projections from your business model, you put them in the context of your tokenomics model with its allocations, its vesting, its inflation rates, and you basically run simulations under these different scenarios to get an understanding of the different evaluation of your token price over time. And this gives you a lower bound idea, a boundary on how you could kind of sustain that price just based on your business model, and not just not outside hype or marketing or listings. You now know what is the price of the token that you can actually sustain as a business. And if you launch it at that price, well, then at least you have something that can grow over time instead of being like only sliding down because the price was one order of magnitude off from what your businesses was actually possible to sustain. And what you can also do now is look at so-called price impact you will have with your liquidity model. So if you launch a token on an exchange, you need to look at the order book. If you are going to launch your token on a decentralized exchange, and you're going to add liquidity to that initial liquidity pool, but you now know what kind of price to aim for that is sustainable. And you can much better anticipate the price impact that is going to happen right after TGE, like when the first unlocks start to happen. So you have a much more data-driven foundation on which you can base your decisions on, and be much more comfortable communicating towards investors and future token holders instead of hoping it's going to work out because you simply don't know, and because you haven't quantified it. Don't see any specific questions coming in about this topic. I hope it is clear why it is important and the kind of approach that you can take to evaluating your token so that you can actually launch it sustainably and making sure it's something your business can sustain by itself instead of having to be sustained by hype. Are there any public examples of such scenario modeling? Yeah, I'll get to that in a minute. We have one on our website as an example. Understand the method to use benchmark figures and then to stress test by plugging into the AMM pool algo. How would you recommend I quantify the amount of sale pressure? Really good question. So yeah, I think there's two components you can plug in. You can either plug in a market making strategy based on an order book in a centralized exchange, or you can use the automated market maker with a more traditional liquidity pool that will determine what the price is going to be. The sell pressure, I think, can be modeled under different scenarios, looking at your vesting schedule and the probability of tokens being sold at different moments in time. I'm going to show you in a couple slides what that could look like in a simulation, but there's no easy way to do this. About simulations, do you run your own in Python or use existing ones on the market? It really depends what we want to simulate. There are simulations out there that there are use cases that benefit a lot more from going very deeply into one specific aspect. So for example, if we need to work with a DeFi protocol, we might choose a Python because we can do a lot more heavy calculations and go much more deeply. For ecosystems that are going to be used to stress test the entire ecosystem and that will also be used to show to investors and to token holders and to create more confidence, we use specialized software. So I'm going to show you that like in the next slide. So very relevant question. Okay. So the fourth common mistake, I think it's a bit sneaky. There's like a couple things in this in this mistake, but I think it's skipping or not taking the responsibility to answer the difficult questions. Like I understand what it means to run a business, to be result oriented, and I work with a lot of founders who want to build incredible things, have great ambitions, and want to move forward step by step. And it means sometimes you need to take a step back or cannot continue because there's a difficult question that you cannot answer. And some of these are, well, how can I actually show that my token economy is sustainable long term? And what would happen if the impact of a slower adoption, like how does the impact of a slower adoption, sorry about this. What's the impact of slower adoption than expected? Yeah, so what if your unit metrics, like the foundation of your business model is different? The average price per user, the number of active users is different. The average TVL in a protocol is lower than anticipated. Like, how would that impact my business and my token model? Because it will impact both. If we end up in a bear market, like if we are gonna get fewer demand in the token just because the market is bad, like what would that look like? Is it 20%? Is it 40%? What if I've overestimated my token's demand? So what if my unit metrics of my business and the relation to the token are overestimated? What would happen if I would take a more conservative and pessimistic scenario? Will things then remain sustainable? Like what will my runway look like to incentivize behavior? And also, like how is all of this over time is gonna reflect back into my token value or my token price in the open market? And these are crucial questions that are not easy to answer from the start. So what we typically do with our clients is that we do actual validation of assumptions using simulations. This is a second method that also can be used to establish token prices over time. So this is a more elaborate method of establishing token prices. It's also possible to actually simulate token prices only using revenue projections, but then you leave out a lot of nuances and it's not possible to zoom in on these other questions that I just showed you. So what I'd like you to take away from this mistake is you can actually analyze and optimize a token model in the context of your business model. you can complex both as a complex adaptive system and run a Monte Carlo simulation, which simply means you run different scenarios of your unit metrics and you run different scenarios of your tokenomics model, and you're going to analyze every different aspect of it within the same ecosystem or within the same system. So what you can do today is you can create a digital twin, implement your business model and your token model, assign probabilities and projections, and use actual on-chain data that you can get from a benchmark or from our database to plug into the simulation and run it under as realistic possible conditions. And with this simulation in place, you are not able just to answer these difficult questions pre-launch or when designing. You can actually feed back on-chain data into this model and also help you assess and make the right decisions with much more confidence once you're already live. So you kind of have this digital twin that you feed constant data that helps you make the next decision in the next phase of your business perpetually, just ongoing. And so you have it's going to be adaptable, it's going to be transparent, and it's going to help you to optimize for long-term performance. Now, how could you implement it? So first of all, you need to be able to implement this kind of this logic of how your business model operates and how your token model operates. Meaning the projections of your forecasts, the expectations about unlocks and selling pressure, and maybe even some market conditions. Then what you do, you open up those projections and add some probability to it so that you open up the bandwidth of possible scenarios. And you can add some agent behavior, such as we have an investor and we expect his tokens will be sold with 80% probability within the next year. And the system kind of takes care of that scenario and how that's all going to propagate and how it feedbacks into the big picture. This is impossible to do in a spreadsheet. Like, you need specialized simulation software for this. And you'll be able to generate insights that are otherwise impossible. Once you've done this, you can actually start zooming in on the different so-called registers of the simulation. So you can start looking at fees that are being generated from transactions, if that would be in your business model. You can zoom in on specific kind of allocations that have been allocated for incentives and understand when you run out of incentive tokens. You can zoom into the actual balance of the liquidity pool. So in this example, we're using a automated market making protocol. And this screenshot, it's just the first level of the simulation. So it's the first layer that you see. There's like 2-3 more layers behind this that connect everything together and make sure that everything works. You can also zoom in on your treasury balance, try to express how many native tokens or stable coins you still have available over that period of time, and if that is going to be a problem long term or not. And also look at the possibilities of outflow of tokens based on your incentive models. So you can almost analyze anything as soon as you have created a digital twin into a simulation and run a lot of different scenarios. So let me look at the questions on this. Okay, not so many questions. If you have any questions later, you can always send me a message on LinkedIn or email. So in the end, what you should be able to get for yourself by building a simulation and trying to get these answers to these difficult questions, you should have a data analysis that's going to give you insights into any risks liquidity shortages, supply shocks, insustainability of rewards and treasury, behavior risks, stakeholder participation, misuse of the protocol, and you can even see if the market sentiment, if it's low, if it would jeopardize your project at different phases. And with these risks in place, you can actually now look at recommendations on how to mitigate them or how to optimize your ecosystem and your tokenomics model. So what would happen if you would increase the APY or increase the incentives for specific activities? And what would happen if you would adopt a different liquidity strategy or a different market making strategy? And this would give you a nice feedback loop into your business and token model to make decisions based on data instead of after the fact and based on gut feeling because the vesting chart was looking nice and why shouldn't it be sustainable? Okay, I see a couple of questions coming in. How much time from idea to simulation is needed? It depends, obviously. Let me check if I can go back to the first slide. So I would say on average, work we do with clients from idea to into the market, 2 to 4 months. From business design, benchmarking, token sale and launch strategy, setup of the initial tokenomics model, stress testing it and simulating it with simulations, building the smart contracts, and then deploying it on chain, somewhere between 2 to 4 months as a rule of thumb. What kind of expertise and people from project team should be involved? Yeah, that's a great question. So what I've learned is that there's typically different roles already available in a team, and none of them are specialized in tokenization or tokenomics, which is the reason we offer this kind of service. Ideally, there is somebody in the team available that is strong with numerical analysis and that understands finance and economics. We also always interact with the development team to understand how things are being implemented and that the tokenomics can actually be put completely on chain as it has been designed. And from a marketing perspective, we do need to understand what kind of strategy is being put in place and what kind of user growth expectations and so unit metrics forecasts based on marketing activities. So that is typically the kind of people we are involved with when we are onboarded with a client in their project team and start to take responsibility on going through the tokenization roadmap. Okay, a lot of questions coming in, so that's good to see. Most projects do not take enough care of treasury management. What would your recommendation be? Should they hire a treasury manager or consultant? Yeah, I think it's a responsibility of the project to understand what it means to manage the treasury and to either hire for it, whether that is a fractional tokenomist like we do, whether that is an advisor that has kind of a financial background, or maybe sometimes even a partner that works with, for example, a crypto accounting company. So those would definitely be recommended hires that we see our clients typically fill in 50-50 internally or outsourcing it. I have a big Web 2.0 business AI platform that replaces people by robots in contact centers. I like to tokenize it and move to Web 3. Yeah, so I think that's where it typically starts. It starts with the idea. My question would be, how would tokenization in that situation, in that business case, how would it add value? Like what do you want to tokenize? Do you want to tokenize the agent intelligence and make that available to others? Or do you want to tokenize how the robots in the AI platform are going to exchange value? So I probably have like 6 questions on this before I can really answer a question on that. But there are a lot of use cases right now looking at decentralized AI or deep in and even decentralized science that seem to be interesting use cases for tokenization and a token strategy overall, especially because they can be governed and be very much on chain. So if you are a Web 2.0 business, there's a challenge of the off-chain components and making sure they have a trustworthy integration with what's happening on chain and what's happening with the token. If you want to move it into Web3, it's gonna be a migration path for you there. And then the question is, what problems will the token help you solve in your new Web 3.0 business that you cannot do in Web 2.0? Okay, I also get some questions here about like how much would it cost? What's the money for the service? We kind of scope everything bespoke for every client, depending on where they're at and what they're looking to achieve, what their roadmap looks like, and also what kind of work we do within that. Do we take end-to-end ownership, or do we work on very specific parts of their roadmap? And based on that, we provide consultancy. Yeah. So that's if you're interested in this, please reconnect with me at a later stage and we can do a discovery call and kind of explore what that roadmap would look like. All right. Final mistake challenge that I see is it's a combination of token distribution mechanics, but also actual token management once the token is distributed. And try to summarize it in 4 distinct points, 4 distinct elements. So I believe that a lot of projects overlook the role of having a well-structured distribution. And when it's poorly designed or manually managed, it's gonna lead to problems. So you're gonna have, if you have your unlocks misaligned with your available liquidity, you're gonna create volatility and you cannot sustain the token. If your token model has supply shocks and inflation that outpace the demand that we've estimated, and that demand comes from utility and it comes from like buybacks from value capture, it's gonna cause problems because then you're distributing too many tokens at prices you cannot maintain. We also see is very clients wanting to do the right thing, so they work with an expert like ourselves. We work on the token model. We put a lot of effort into making it right, and then it's not enforced on chain. So you're basically doing everything you need to do, but at the end, you're not putting everything that you have designed and developed on chain, which means funds are either kind of pre-minted and held in one wallet, which exposes it to risk. Not even sometimes multi-sig wallets. There's no automation on any payments or vesting, meaning you have to do that everything manually, and then you're running behind, or you add a 0 too much, and now all of a sudden you have distributed 10 times more than you were trying to distribute. I see complete chaos there, which really surprises me because there's great solutions out there that can help you manage this. And then also security vulnerability. So I see founders and especially smart contract developers working already with founders, building custom smart contracts, building custom functionality for tokenomics, for specific for claiming, for airdropping. This means you're building custom code that needs to be audited, which is always at risk when you deploy something on chain. You also could have used available, audited, transparent smart contracts that are already out there, that don't incur you a lot of cost up front, that are already kind of tested and verified, and basically immediately available to use, so you can kind of shorten your time to market. So what are the solutions to these? I obviously mentioned already a couple ones. You need to make sure you model unlock schedules against any kind of expectations in trading volume and liquidity depth and token demand. So you want to quantify your early token releases, and you want to quantify that against your business projections and the initial liquidity you can make available after your fundraising. You also want to ensure transparency and traceability to create the trust with all the token holders by having everything in smart contracts and by making them the flows of value verifiable by everybody, so that you can maintain and build that trust with all the stakeholders that have trust, that put the trust in your token ecosystem. Then using software for like automated vesting, making payouts to your team on chain. Like instead of keeping track of things in spreadsheets, use specialized software. Don't use a single wallet without proper security. Make sure that you use a multi-sig or a custodial wallet that's properly managed and that can only be accessed through specialized software or smart contracts, so that everything is transparent, secure, and it's fully auditable. And then finally, instead of doing all these manual transfers, you using custom tooling for that. Don't build everything from scratch. Like, save yourself the time and go to market, reduce your risk, and use some audited software for that. I'm going to show you which software we recommend and we kind of endorse right now because of a couple reasons. And also, So we're sponsored, or also this webinar is sponsored by Sablier, and we haven't known them for very long, but we do very strongly believe in the kind of transparency, automation, and real-time settlement values that they put into their software. So what we see based on what I just showed you is that there's a constant demand within our clients for token vesting, for airdrops, on-chain payrolls, and you don't want to build that yourself because of all the risks that I just mentioned. So especially in the early stages when things are costly, it's very interesting to look for an audited solution that can actually be paid with a pay-for-use model, making it very accessible for you to go to market quickly and don't take all those risks by building something custom and doing things manually. So shout out to Sablier, please give them a look. Been in the space for a long time, support a lot of chains. I've supported over 344 million in transactions totally, and are trusted by industry leaders. All right. Before I go to thanks for joining, I still want to answer a couple of questions here, which I kind of missed. Could you please name some protocols and tokens you've helped so far? Yeah, there's an extensive list on our website as well. We've worked with different on-chain protocols, and like we have worked with GameFi games, like Pikamoon. We've worked with RWA platforms like Galileo Protocol. We did some consultancy on LCX. We're working with RWA platform in South Africa called Damref right now. So we work across different use cases, but everything on chain. Tokenomics are usually subject to change at the discretion of the company. That depends what you put on chain, but yeah, if you do not put it on chain, then that's true. Do you think it's fair for issuer management to change vesting schedule or access tokens early in certain situations? Well, I can imagine there's situations where that is desired, but I think it's not according to the agreement you have when you have put something on chain, which is why I believe that putting something on chain gives you that guarantee and make sure that distributions, vestings will all go to according what has been agreed upfront and cannot be altered later. So that's why deflationary tokens give guarantees. Smart contracts vesting the tokens give guarantees, and should be a good practice. And automated vesting indeed would stop you from doing that. Yeah, so that's why it's important to get your basics right up front and give your token holders into like at that moment in time, stick to the guarantees that they have signed up for and not alter it one directionally. So if you want to alter something on chain, it should be done with an on-chain vote in the token and not by the discretion of the smart wallet, smart contract account owner. All right, then I see no further questions. I see a couple of thank yous and yeah, I appreciate you guys for joining this event. I hope you got something from it. Probably kicking in an open door, but if you need any expertise, expert guidance in this, in your strategy, you want to set up a token model and want to have a successful launch, or you're running already with a tokenomics model, but you need a second opinion, so you want to audit it and stress test it, then don't hesitate to reach out. You can connect with me online, on LinkedIn, book a meeting, or meet me at a conference. I believe if you scan this QR code, you're gonna be able to get the links to connect with me and also leave some feedback. So thank you very much. And I hope to see some of you later and wish you a good afternoon.